Hello and welcome. In this lesson, we're going to master one of the most critical frameworks in modern trading, top-down analysis. We'll define it, break it down into a simple three-step process, and then put it all together with a real-world trade example on pound sterling to Japanese yen. By the end of this, you'll understand how to align your trades with the broader market structure for higher probability setups. Let's begin. So, what is top-down analysis? Simply put, it's a method of analyzing the markets from higher to lower time frames. Think of it like looking at a map. You start with a view of the entire continent to see the overall landscape, then you zoom into the country, then the city, and finally the specific street address. This method prevents you from getting lost in the noise of a small chart. The purpose is threefold: to identify the overall market trend. Are we in a bull or bear market? To locate major areas of liquidity, those swing highs and lows that the market is likely to target. To use this information to determine high probability trade setups on your entry timeframe. This leads us to why this is so vital for traders using smart money concepts. Top-down analysis is the bridge that connects smart money concepts with structural market analysis. It's how you think like an institution. It helps you do three key things: align your trades with institutional order flow. The big players operate on higher time frames. By starting there, you're seeing the market through their eyes. Avoid trading against the market structure. How many times have you taken a trade on a 5-minute chart, only to see it reverse because you were selling into a major daily support? Top-down analysis prevents that. Confirm support and resistance zones. A level on a 15-minute chart is weak. That same level, coinciding with a major daily order block? That's a high probability zone. Now, let's break down the practical three-step process. Step 1 is higher timeframe analysis. We're looking at the weekly and daily charts here. Your key tasks are: identify the overall trend. Is it up, down, or ranging? Mark major support and resistance levels. These are the significant swing points on the chart. Highlight liquidity areas. Where are the recent swing highs and lows that the market might be drawn to? The output of this step is a clear bias. You will know whether you are primarily a buyer or a seller. This is your strategic direction. Step 2 is intermediate timeframe analysis. We move down to the 4-hour and 1-hour charts. This is where we refine the story from the higher timeframe. Our tasks here are: spot market structure breaks. Look for shifts and pullbacks within the larger trend. A bull market doesn't go straight up, it has pullbacks. We want to buy these pullbacks. Refine those higher timeframe levels. That daily support zone might be quite wide. On the 4H, we can pinpoint a more specific area. Look for order blocks and potential liquidity grabs. This is where we identify the engine rooms, the specific price zones where institutions are likely to have placed their orders, causing the next significant move. This step gives us our tactical zone, the specific price area where we will look to engage. Finally, step 3 is lower timeframe analysis. This is where we execute, on timeframes like the 15-minute and 5-minute. Our job here is precision: confirm entry criteria. Is price actually reacting at our predefined zone from the 4H chart? Observe price action at key zones. Are we seeing rejection, consolidation, or a clear break? Identify precise entry criteria before we enter the trade. This three-step process ensures every trade you take is backed by a logical narrative that flows from the macro to the micro. Now, let's see it all come together in a practical example. Before we look at the charts, remember the golden rule: integrate your higher timeframe bias with SMC. This means you only trade in the direction of the higher timeframe trend, and you use the lower timeframes solely for precise entries. You are not looking for reversals against the main trend, you are looking for confluent entries to join it. Let's walk through a real chart example. We'll follow the path: weekly trend 4H structure 15M entry. We'll highlight the order blocks, liquidity areas, and the exact entry point. We're using pound sterling to Japanese yen for this demonstration. Step 1, the weekly chart. Our goal here is to identify the trend and liquidity. Look at the chart. The trend is unmistakably bullish. We have a series of higher highs and higher lows. However, if we look closer, we see price wick above the high of the previous week and close within the range. A classic liquidity sweep, signaling a pullback. Our bias, therefore, is to look for sells, targeting last week's low. Step 2, now our weekly analysis makes perfect sense. We know we're looking for a move down to target that weekly low. Our tasks here are: identify structure. We can see the market has already started the pullback. The break below a recent swing low confirms the start of this move. Refine HTF levels. We need to find a level where this drop might pause or find resistance. We're looking for a place to potentially sell into a retracement. Identify order blocks, and here it is. This highlighted area is now a bearish breaker block after it fails to act as support. According to SMC, when price retraces back to this block, the original sellers are likely to step in again to continue the move down toward our weekly target. Our plan is now tactical. We wait for price to retrace back up into this 4H bearish breaker block to find a selling opportunity. Step 3, the 15-minute chart. This is where we get our precise entry. We are now looking for a sell signal. Watch the price action. We see a bearish break of structure with displacement. We wait for price to retrace into the fair value gap. This becomes our trigger to sell at market opening, placing our stop loss at the top of the first candle of the fair value gap. The fair value gap as well as stop loss placement are highlighted in yellow. This signifies a perfect confluence for a short trade. The entry aligns with the bearish breaker block, the expectation of a move down to the weekly low, and the kill zone timing. Let's recap the key takeaways from this entire lesson. Top-down analysis ensures alignment with market structure. It keeps you on the right side of the market. Higher timeframe context is crucial for SMC trading. It's your foundation. Never trade without it. Lower timeframe analysis increases entry precision. It turns a good zone into a great entry. Always respect smart money concepts while entering trades. Look for order blocks, liquidity sweeps, and confirmation. This methodology is what separates amateur reactionary trading from professional, strategic trading. So, what's next? You need to practice. Before you even think about entering a trade, practice analyzing charts top-down. Make it a daily ritual. Focus on combining the 3 pillars: market structure, liquidity zones, and order blocks. I suggest you start with these exercises. Do a weekly and daily analysis on 3 major currency pairs. Mark the trend and key liquidity zones. Then, go to the 4 or 1 hour, even 15-minute timeframe if you plan on entering in the 1-minute chart and identify structure and potential order blocks within the trend. Finally, use the 15, 5, or 1-minute chart to practice spotting entry triggers without actually trading. This disciplined approach will build the muscle memory you need to succeed. Thank you for watching. Now, go open your charts and start practicing. Happy trading!